What if I told you there's a clear step-by-step blueprint to turn rupees 5,000 a month into 1 crore rupees? That's the promise of this video. If you're planning to finally start investing in 2026, you've probably noticed most advice is either too basic or drowning in jargon. I am not a financial advisor. This is the exact system I used to build my own portfolio past the 1 crore mark. And in the next few minutes, I'm giving you the complete playbook. The biggest risk to your wealth isn't a market crash. It's doing nothing while inflation eats your savings. The Indian economy is set for robust growth, with both the RBI and ADB raising their GDP forecasts for the 2025-26 financial year to around 7.2 to 7.3%. This is your ticket to participate in that growth. It's time to build your blueprint. This is where it all begins. Your first goal isn't to get rich overnight. It's to build a habit. Now here's where many beginners go wrong. They treat the stock market like a casino, chasing hot stocks. That's not investing, it's gambling. Our strategy is the opposite. We're not betting on one company. We're investing in the entire Indian growth story. And the simplest way to do that is with a Nifty 50 index fund. Think of the Nifty 50 as India's 50 largest, most influential companies. An index fund doesn't try to beat the market, it is the market. By investing in one, you are instantly diversified, dramatically lowering your risk. So why an index fund? 3 reasons. It's cheap, they are passively managed, meaning very low fees. More of your money works for you. It's simple. You don't need to be an expert or time the market. You just invest a fixed amount every month through a systematic investment plan or SIT. And it works. Over the long term, studies like the SPI VA India scorecard show most active funds fail to beat the market index. By simply owning the index, you guarantee yourself the market's return. Your first mission? Start a Rs 5,000 SIP in a low-cost Nifty 50 index fund from a fund house like UTI, HDFC or ICICI Prudential. This single step puts you ahead of millions. At this stage, your focus is 100% on growth. This first SIP is your cornerstone. Don't overthink it, just start. Once the habit is set, it's time to fire up the growth engine. We do this with asset allocation. It's a simple rule. Don't put all your eggs in one basket. Decades of research show asset allocation is the single biggest factor in your long-term returns. For an investor in their 20s or 30s, a great model is the 80-15-5 rule. 80% in equity, your main wealth creator, the engine powering you to Rs 1 crore. 15% in debt, your portfolio's anchor. It provides stability when the market gets choppy. 5% in gold, your portfolio's insurance policy. Gold often zigs when stocks zag. If your monthly investment is now Rs 25,000, here's the breakdown. Equity Rs 20,000, add a FlexiCap fund to your Nifty 50 SIP. FlexiCap managers can invest across large, mid and small companies, hunting for opportunities. You could split this, putting 10K in your Nifty 50 SIP and 10K into a FlexiCap fund. Debt Rs 3,750, start an SIP in a high-quality corporate bond or short-duration debt fund. They are far less volatile than stocks and aim for stable returns. Gold 1,250 rupees, the best way to own gold is through sovereign gold bonds or a gold ETF. Sovereign gold bonds are great because they offer a 2.5% annual interest on top of gold's price appreciation, and gains are tax-free if held to maturity. This structure pairs a powerful growth engine with a reliable shock absorber. It's a balanced approach designed to let you sleep at night. Ready for the secret sauce that can shave years off your journey to 1 crore rupees? It's called the Step Up SIP. If you remember only one thing from this video, remember this. A Step Up SIP means you increase your monthly investment by a fixed percentage every year, ideally linked to your annual salary hike. Get a 10% raise, increase your SIPs by 10%. This small change unleashes compounding magic. Let's look at the numbers. A Rs 25,000 monthly SIP, assuming a 12% annual return, could reach Rs 1 crore in about 13.5 years. But with a 10% annual step up, that same SIP could hit the 1 crore mark in just over 10.5 years. You've just cut 3 years off your goal. As your portfolio grows, you can add a turbocharger. Consider a small tactical allocation, 5 to 10% of your equity, to a thematic fund like technology or green energy. And don't forget tax saving. An equity-linked saving scheme or ELSS is a mutual fund with a 3-year lock-in. Under the old tax regime, ELSS investments up to Rs 1.5 lakh are eligible for deductions under Section 80C. It's a smart way to get both growth and tax benefits. As you near your 1 crore goal, your mindset must shift from pure growth to capital preservation. Imagine your 90 lakh rupees portfolio dropping 30% in a crash right before you need it. Portfolio rebalancing is your shield against this nightmare. It's simple. You periodically realign your portfolio back to its target allocation. Remember our 80-15-5 rule? If a great year for stocks pushes your equity to 90%, you are taking on more risk than you planned. Rebalancing means selling some equity profits and reinvesting that money into debt and gold to get back to 80-15-5. This forces you to do what most investors are too emotional to do: automatically sell high and buy low. As you get older, make your allocation more conservative. In your 40s, you might shift to 70% equity, 25% debt, 5% gold. In your 50s, you might move to 60% equity, 35% debt, 5% gold. This locks in gains and protects your hard-earned wealth. Rebalancing ensures the fortune you build is the fortune you keep. The blueprint is simple, but following it is not easy. The biggest hurdles are in your head. Here's where most beginners blow up their portfolio. Mistake number 1: panicking when the market crashes. A crash isn't a possibility, it's an inevitability. Your instinct will scream sell. This is the single most destructive mistake you can make. For a long-term investor, a market crash isn't a threat, it's a sale. The best companies in India are on discount. Your monthly SIP is your superpower, as it automatically buys more when prices are low. This is called rupee cost averaging. While others panic, your plan ensures you're buying low. Mistake number 2: chasing hot tips. Friends, WhatsApp groups, social media, everyone has a guaranteed tip. The temptation to ditch your strategy for a shiny object will be intense. Don't. A boring, disciplined plan you stick with for 15 years will almost always beat chasing a needle in a haystack. Success is born from patience, not from getting lucky. And that's the blueprint, the 4-step plan to a 1 crore portfolio. Step 1, the foundation. Start a Rs 5,000 SIP in a Nifty 50 index fund. Step 2, the growth engine. Build an 80-15-5 asset allocation. Step 3, the acceleration. Use a step-up SIP to increase your investment annually. Step 4, the rebalancing act. Protect your wealth by rebalancing as you near your goal. The path to financial freedom isn't a secret. It's a formula of discipline, patience, and belief in India's growth story. The blueprint is here. The math works. The only variable is you. Stop waiting for the perfect time. The perfect time was yesterday. The next best time is right now. Your journey to Rs 1 crore starts today.